So good morning and welcome. My name is Teresa Campbell, and you have joined the PIM and PIA Mid-America Financial Executives Council discussion on strategies in taming inflation, maximizing employment, and starving off a recession. Now note that all of our attendees are placed in mute mode during the session to ensure a quality recording, which will be made available to all members following the program. We do, however, encourage you to comment and ask questions during the program by raising your hand, and you can do that by selecting the reaction button at the bottom of your screen, and Ben will unmute you, or you can type your questions in the Q&A field at the bottom of your screen. We'd like to keep technical difficulties in the chat field, so if you have any technical issues, let us know through the chat field. Now, our Financial Executives Council has leaders from both regions that guide the program and content offered every other month. It is focused on financial reporting and compliance, data management and security, and financial policies and planning. Our council co-chairs are Carl Nathy with Myers Printing, Ken Rain with Daily Printing, Ryan Wagner with Action Mailing and Printing, and Rick Riescraft with LB Carlson. Rick, let's get started.
Good morning or good afternoon, everyone. Thanks for joining us. I thank you especially to Joe Mahon from the Federal Reserve in Minneapolis here for being our guest speaker. I wanted to give a shout out before we get going to Ken Ryan from our committee. Ken has took the lead in lining up our guest speaker today, and that was done several months ago. So we just appreciate Ken's work on that. I want to introduce Joe, and Joe is going to be talking about a number of things today. Joe is the regional economist for the Federal Reserve Bank in Minneapolis. He has served as a regional economist and as a staff writer and analyst for the Federal Reserve. Been involved with them for quite a while. Joe is going to cover a number of topics today. We're going to try to make this a interactive presentation. So we're going to, like Teresa said, we use the Q&A and chat features to try to talk to Joe's points and ask questions wherever you feel free. And I know Joe will pause once in a while to try and get feedback that way as well. And some of the things that we'll cover today are up there on the screen right now, but I'm going to turn it over to Joe. He can introduce himself a little bit better than I have, and then he has a PowerPoint to share as well. So welcome, Joe.
Thanks, Rick, and thanks to Ken Ryan for reaching out to me and connecting and inviting me to speak here, and thanks to you all for listening to me today. I hope that it's informative, and we have a good back and forth. Let me get my slides up for you and make sure that you can see them all. How are we looking? Can everyone see it? Good. Okay. Well, just a couple things to start out. Just to kind of level set here. I'm going to be talking mostly about the national economy. So I work for the Minneapolis Fed. My job is to follow economic conditions in our region. But I know that we have some folks from well outside of our region. So I'll talk a little bit more about that in a minute. I am going to try and make use of some live audience polling slides that you can participate in through your cell phones. You don't even need a smartphone. Actually, it's just a text response feature. And so we'll see if that works. And I think that'll be a good way to kind of have some back and forth. But I do, as Rick said, encourage you to please chime in with questions. They're going to be watching the Q&A for questions, and I'll be happy to interact with you. I'd much rather have a dialogue and hear what you all have to say, because that's an important part of why I am with you today, is to kind of gather some economic intelligence from you and hear what you're experiencing in our economy right now. That's a big part of my job and what we do at the Fed. So rather than just yak at you and give you a lecture for an hour, I'd much rather hear what you have to say. And I do have a fair amount of material. And if I don't get through it all, I see that as a good thing. One more thing just to get out of the way, housekeeping matter is just to make it clear, our lawyers like us to to give a disclaimer every time I'm speaking somewhere, just to make it clear that I am speaking for myself and not necessarily for my colleagues at the Federal Reserve Bank of Minneapolis or within the Federal Reserve System, at least with regard to any opinions I might express. As I'll explain in a moment, the Federal Reserve kind of has a unique role in the economy. We have a sort of a unique structure too, but one thing that's really important about our structure as an institution is that we are nonpartisan. So we try and, in order to do a good job of making economic policy, it's important for us to have some independence from the political process. So we try and stay out of politics as well. That doesn't mean that I don't have my own political views and that my colleagues might not as, might as well. It just means that I try and keep them to myself and not inflict them upon all of you. And I'm sure coming out of an election season, you'll all probably be grateful for that. So here's what I'm hoping to talk about today. I'm going to give you a little bit of background on the Fed and what we do before I get into kind of the economic update. And in particular, I'll talk about kind of what the two sort of pillars that guide the economic policy making by the Fed, and those being labor market, specifically employment and inflation. Not news to anyone here. You're dealing with input costs every day. You know that inflation is up, and it's become a serious problem, not just for businesses anymore, but for households and families as well. And the Fed, it may seem that we've kind of more abruptly changed our stance toward the economy and started kind of tightening very aggressively recently. I kind of want to give you a sense for what's been going on, what's been behind what might seem like a fairly sudden pivot. Make the case actually that it's maybe not as sudden as it might seem, but I'll kind of set up basically where the economy is before I get into talking about what the Fed is doing in response to the higher inflation we have right now. One thing I should say is, at the outset is usually that disclaimer I give covers me for any stupid thing I might accidentally say. But one thing that's important for me to do, and one thing that I always avoid doing, is giving you any kind of forecast for the future path of interest rates. And honestly, that's sort of a matter of policy, but also your guess is as good as mine. If you are an informed reader of the financial press, if you follow the world news around you, you have probably is just as good an idea what's going to happen as anyone else. And the Fed tries to be pretty transparent about our intentions in the future and what guides our thinking about that. So what I hope to give you, if not a prediction, we're going to raise rates X number of times over the next 6 months. Rather, what I want to do is give you an appreciation for what are the factors that kind of influence those decisions and guide the thinking around that. And the other thing that I want to do, as I mentioned earlier, is get some feedback from you. A big part of why I do speaking events like this, both to kind of answer people's questions about the Fed and get our get information out there, is to get information back from people like yourselves, businesses that have a lot of good intelligence about what's happening in the economy right now, intelligence that might not be showing up in the data yet. So as I mentioned, I've got some live audience polling slides, and I hope that it should work pretty well. What I need you to do just before I get into the rest of my presentation is to follow the instructions that I'm putting up on the screen right now to get logged in. So I want you to get your phone out and open up your text feature. Usually I don't like when I'm giving a speech and a lot of people are looking at their phones, but in this case, that's how you're going to be responding to the questions that I'll be putting up. Those are going to be multiple choice questions mostly. And what I want you to do is send a text to the phone to the number 22333 and just text the word Minneapolis and then hit send. You should get a response from us. And when the survey questions come up, you'll just be responding to the questions that I ask on the screen via responding at A, B, or C, and you'll see the prompts on the screens when I do that. You don't need to open up the link that'll pop up when you get a reply from the text message that you send. You can just use the text feature on your phone for that. So I'll leave that up for just a minute before I kind of get into the next part of my talk, which is just to kind of get into a little bit of background on the Federal Reserve. So the Federal Reserve, for those of you, just to kind of level set so everyone knows exactly what the Fed is and what we're not, is we're America's central bank, and we are responsible for a number of important roles in the economy. But one important thing that I should probably get out of the way right away is to mention that we are not, in spite of the name federal, actually a federal agency. We're the Federal Reserve is essentially a nonprofit corporation. So we were created by the government to serve a particular role. And so in that regard, we're pretty similar to Amtrak, or especially to the post office, in that we're not a part of the federal government. We're a nonprofit corporation that was chartered by the government to serve a purpose. But we are accountable to the government because we were created by Congress. And what we were created originally to do was to be a central bank, to be a lender of last resort in times of financial crises, to make sure that there was adequate liquidity to financial institutions that needed it in times of in banking panics, when there are bank runs. This time of year, I always like to reference the movie It's a Wonderful Life, because there's a classic scene of a bank run in that movie, and that's really what the Fed was created to respond to make sure that institutions that were subject to financial shocks, not necessarily because of their own faults, but because of conditions that were beyond their control, could draw on temporary lines of credit to stay afloat while the storm passed. Now, in order to do that job, because we have the authority to lend to financial institutions in time of emergency, we also have regulatory power over them to make sure that they don't get into trouble in the first place, because we don't want to be bailing out people for and saving them from the consequences of their own bad behavior. And so that's why we have a pretty important role in regulating banks as well. That's about all I'll have to say about bank regulation today. I hope that that's not a problem for any of you. I'm not a regulator. My job is kind of in relation to one of the Fed's other roles. So what are those roles? I mentioned already, the sort of financial stability, lender of last resort feature, and bank regulation, which is intimately related to that. So kind of supervision, regulation, financial stability is one big leg of responsibility. The other is financial services. We are a bank. We are a bank for what makes a central bank is just a special kind of bank that's a bank for other banks. So they keep deposits at the Fed. They're regulated by the Fed. They can draw on our lending facilities, the discount window, and others. And we're also the U.S. government's bank. So when you pay your taxes every year to the IRS, that goes in the U.S. Treasury's account at the Federal Reserve. So we are a bank. We provide financial services. We process electronic payments. We sort of run the rails that a lot of the financial system runs on. The payment system, both retail payments, the ACH system. If any of you, most of you probably have your paychecks auto deposited. That goes through one of our infrastructures, and then separate infrastructure for large payments. So that's the kind of banking operations part of our work. And then the other thing, the thing that we're best known for, and what I'm going to spend the rest of my time talking about, is monetary policy. And that's the influence of the supply of money and credit in the economy, conventionally referred to in the financial press as raising and lowering interest rates. And we make that with two goals in mind. So just to kind of wrap up sort of the institutional structure of the Fed, we are, I mentioned, we are a bank. We keep reserve deposits from banks, from depository institutions. So we're a sort of bank for banks. That's the reserve part of our name. What makes us federal is that even though we're not a federal agency, we're a decentralized central bank. And so that's kind of drawing on the American tradition of distrusting concentrations of power. When the Fed was created in the early 20th century, they decided to divide the country up into Federal Reserve districts. And you can see that map here on your screen. They divided the country up into 12 Federal Reserve districts in order to make sure that we were representing the different parts of the country and the communities around the country, not just making these decisions in the interests of Wall Street and Washington, and that we weren't just beholden to them, but also representing people around the country. And so you can see the map of the Federal Reserve districts. I know that we have some folks here that are in the Dallas district and that are in the Kansas City and St. Louis districts as well. I'm in Minneapolis, so I represent the Minneapolis Fed. I mentioned that one of the system was designed in this decentralized way for kind of political, institutional reasons. But one of the features of having designed the system that way is that in making policy for the whole country, for an economy as big and complicated as the United States, it makes sure that we're drawing on information from communities all over the country, and not just, like I said, the big financial centers on the coasts. And so our region that we were responsible for at the Minneapolis Fed is on this map here. We cover Minnesota, but also the states of North Dakota, South Dakota, Montana, and then we have portions of Wisconsin and Michigan, the northwest portion of Wisconsin, the Upper Peninsula of Michigan. So that's our region. And most of the time when I'm out giving talks like this, I would be talking about the economy in our region. I know we have a lot of people from outside of our region, and as it happens right now, there's a lot of interest even with the local audiences that I speak to on national issues. So really getting back to that kind of monetary policy picture. Monetary policy is one of the two main levers of national economic policy, the other being fiscal policy, that's taxing and spending powers by Congress and the president. We're not involved in that. What we do is we influence the supply of money and credit in the economy. In particular, we target a benchmark interest rate, the Fed funds rate. Happy to talk more about that. But what I want you to keep in mind before I get into the main meat of what I have to say here, which is really what's happening in the economy and what the Fed is doing about it, is we are required by federal law to make monetary policy with two goals in mind. We sometimes refer to this as the dual mandate. And those two goals are maximum employment and price stability. And so those are the two things that we really stay focused on when we are making those decisions about interest rates. One more quick note, just about kind of explain sort of how the system works. So you have these 12 reserve banks that are spread around the country. Then you have the Board of Governors in Washington, D.C. That is a government agency that oversees the operations of the Fed. So sometimes you'll hear the term chair of the Fed referred to. Currently, it's Jerome Powell. Prior to Jay Powell, it was Janet Yellen, and before her, Ben Bernanke and Alan Greenspan. Some of you might remember all the way back to Paul Volcker. Arthur F. Burns, previous chairs of the Fed. What that person actually is the chair of the Federal Reserve Board of Governors, which oversees the operation. There are 7 governors total in Washington. And what happens 8 times a year, the presidents of the 12 reserve banks travel to Washington, they meet with the Board of Governors, and they determine what that benchmark interest rate target should be. And that's called the Federal Open Market Committee. So later on, when I'm talking about what the Fed's doing about inflation, I might by shorthand refer to the FOMC or the committee. That's what I'm talking about. I'm talking about that body, which is a collaboration between the 12 reserve banks and the Board of Governors that oversees the operation of the system. And what they do is they set a target for the stance of monetary policy, but it's the job of the trading desk at the New York Fed to actually execute the financial transactions to make that happen. Happy to talk more about how that process works later, but I don't want to get too lost in a tangent. I just think it's important setup to kind of explain how this works, how we go from me gathering information from businesses and communities across our region, feeding that up the chain to our policymakers, to our president, Neil Kashkari at the Minneapolis Fed, and then bringing that information to the table when they have those meetings. One of the things they do at those meetings is they go around the table and the 12 reserve bank presidents give an update on economic conditions in their region. So that's one way of making sure that we're representing the different parts of the country. And that's kind of what my job is to be a regional economist for our region. So with that said, I kind of want to start out by getting your quick read on the economy, but more specifically how things are going currently for your business. So I want you to think about kind of recent activity at your business, be it sales, new orders. And if you could go back into the cell phone poll app, the text feature on your phone, and take a look at this question and chime in with one of these categories. You can see them labeled here, and it looks like we've already had some responses, so it seems like folks are getting it. But if you would say you're seeing significant decline in recent business, I would want you to enter A, a little decline, B, stable but low, that would be C, stable but good would be D. If you're seeing some improvement, then or some increase in recent activity, then that would be an E. And if you're seeing really strong growth right now, enter an F. And I'm going to give it just a couple moments longer here just to allow people to chime in. This is just a good way to kind of get a quick read from you all. Back in the day, before I had the access to this technology, and I do most of my speaking event in person, I would just kind of do a show of hands in the audience. So this is a kind of a way of doing that, but in a more precise way. And I hope this is interesting for you all. You can kind of see what some of your colleagues and or competitors are seeing right now. And it's really helpful for me to get this kind of information because, like I said, I can kind of gather your insights, and they're not necessarily just from our region, but kind of a bellwether industry like printing to kind of see how things are going on right now. And I really do think that a lot of you represent, pretty kind of leading bellwether type of businesses. So it's really a good opportunity for me here today. So it looks like folks are done chiming in, and it looks like the majority of you are seeing steady business at good levels. Some of you seeing declines. Nobody's seeing improvement right now, which is interesting. And that kind of sets the tone, I think, for a lot of what you're hearing about the overall economic situation going into next year. There's a lot of discussion about whether we're currently in or heading into a recession. Again, happy to answer questions about that if that comes up. And I want to get into now your outlook right now for the first half of next year. Maybe kind of biased you a little bit with that recent question. If you're really expecting a big downturn in the first half of next year, text me an A. If you're expecting, a little bit of a slowdown into next year, B, steady, stable, not really sure, even you could text C. And if you're optimistic, D. If you're really optimistic, pie in the sky, send an E. And I'll give it a little bit longer for folks to chime in here. So again, to just kind of distinguish, I want you to think about, the first 6 months of 2023, based on what you're seeing right now, what are you expecting? It looks like most of you are coming in with stable. And given that most of you said that things right now are stable at good levels, I'm going to take that as somewhat good news. It's, given some of the other, kind of drumbeat of negative news we're seeing in the economy lately. So this is good. I'm glad you're kind of sharing your intel with me. I'm gonna probably move on. This was really just an attempt, these 2 slides, to kind of get you accustomed to the polling technology. I'll go back to some of these questions in a minute. In fact, I might have another couple more for you here real soon. Just to get into but now I'm going to get into just the overall economic update. And again, I want to go back to those 2 key things I'm going to keep hammering back on are the labor market, employment, and inflation. We know a lot of businesses are experiencing severe labor shortages right now. I'm going to ask you about that in a moment. We know inflation is up right now, so that's kind of what I'm gonna be going through, kind of. But I'm going to start with just a quick overview of where we are now in the labor market relative to the pandemic. But I want to ask you first about what your plans are at your companies for hiring right now, not necessarily what you're expecting to happen to employment in the economy, which is what I'll be talking about in a minute, sort of macroeconomic aggregate employment. But what are your plans right now going into next year? If you're hiring only to fill turnover from existing positions, that would be A. If you're just hiring part-time or seasonal, that would be B. Trying to expand full-time employment, that would be C. All of those above would be D. If you're keeping things steady, that would be E. And if you're cutting workers right now, doing any kind of layoffs, that would be F. It looks like most of you are looking to hire so far. I'll give it a little bit longer to chime in. I'm gonna ask you another question in just a second, kind of in a related note about the labor market again, because I know a lot of folks are dealing, with the biggest concern I hear from businesses in our region is the labor shortage. And that's been true for a long time in our part of the country, where we're kind of in a permanently tight labor market, kind of lower rate of population growth. Prior to the pandemic, that was the majority of what I spent my time talking about, was kind of the labor market situation, what was behind it, why we were seeing such tight labor market conditions. So I'm going to ask you about that right now. Not necessarily what you're seeing, over the long term, but just over the course of this year, or really since the spring, roughly. Have you been seeing labor availability getting better or worse? If it's a lot worse than it was, say around March, April, I want you to enter A. If it's a little bit worse, it's still getting tighter yet, that would be B. If you haven't seen any change in C, and then it looks like you're already seeing the options, you're familiar with how this is working right now. Somewhat better is D, much better is C. Looks like we've got somewhat worse and no change going neck and neck right now. And then a few people saying somewhat better, which is interesting, because I'm going to get into the labor market indicators in a moment. So I promise this is the last one of these questions I'll ask for a little bit here, and then I'm actually going to get into the economic situation in just a moment. Yeah, it looks like we've got a pretty good balance between some people saying that labor's gotten less available, and some people saying that that it's pretty much just the same as it's always been, which I'm going to assume is not a lot of availability, and then a few of you saying that things have gotten a little bit better recently. So that's interesting to see because it's, yeah, as I'll show you in a moment, it's kind of consistent with what some of the data at least are showing us. So as I mentioned, a lot of what I'm going to show you a lot of charts that look like this, because even though a lot of us, really want this pandemic to be over, and in a lot of ways it is. In some ways, we're still dealing with the economic consequences of it. The pandemic was sort of a, let's hope, a once in a generation or once in several generations event, shock to the economy, and we're still dealing with some of the repercussions of it, particularly with regard to the impact on inflation. And that's kind of the story I'll be telling you in a minute. But I'm going to start with the labor market picture. So you can see here the unemployment rate. You're all familiar with the unemployment rate, I'm sure. That's just an attempt to measure how much excess capacity or slack there is in the labor market. That soared in April of 2020. And it's come down actually compared to historical recessions very quickly. And we're just about back to our pre-pandemic level of unemployment. It jumped a little bit in the last month. You don't want to pay too much attention to 1 month of data. And apologies, my labels are off on this axis here. The end of this, the last few months here are duplicating, but the end of this is October. We saw U.S. unemployment increase to 3.7% from 3.5%. And that was due largely to increase in the the labor force, but generally speaking, very low historically speaking, a very low rate of unemployment. We're just about back to where we were prior to the pandemic. And I'm sure if I talked to many of you prior to the pandemic, you would have told me it was a really tight labor market. And we know that from the data. I'll show you some data on wages in particular, and what we can say about that. Just to give you kind of another sense of how big of a shock the pandemic was. This is overall employment, so the total number of people working. Every month, the Bureau of Labor Statistics releases these two stats, the unemployment rate and the employment level. They come from two different surveys. They usually get a lot of headlines. The one survey that we get the unemployment rate from comes from a survey of households. They call people up, ask them if they've been working. If they haven't been working, they ask them if they're looking for work. And those people who are out of work but looking for work are counted as unemployed. A lot more I could say about that. It's some of its inadequacies as a measure of the labor market, but employment comes from a survey of businesses. We call it the payroll survey sometimes. And this is just a total measure of the number of millions of people working in the US. And as you can see, this fell by 22 million people from February to April of 2020. And again, by historical standards, a very quick recovery. But if you go back to the middle of 2021, when we started to see inflation take off, we were still 6 to 8 million fewer people working than we had pre-pandemic in the US. And so the Fed, when I get into, later when I talk about kind of Fed's policy response to the pandemic and what we're doing in response to the inflation surge that we're seeing right now, a year ago when we started to see inflation take off, we were still well below that full employment target. We've just recently, as of August, gotten back to peak pre-pandemic employment. That's not necessarily where we would be had the pandemic never happened, because employment tends to grow over time. But we're back to the level that we were pre-pandemic now. Another way of looking at this is to say, where are we relative to the share of the population who are working? And that also has recovered pretty quickly, but it's over the course of the last year or so been hovering below its pre-pandemic peak. That's, again, not to say that that the pre-pandemic peak in the employment to population ratio was the right level of employment, was the full employment level or something like that. Just to say that we know that, a year on from this huge drop in the employment rate that you can see, again, this fell by nearly 10% from its peak. The number of people that are sort of employable age that are employed fell by 10%. climbed back pretty quickly, but as of a year ago, was still well below pre-pandemic level. And so that's just owing to continued growth in the population. But a lot of people we know have pulled out of the labor force for a variety of reasons. A lot of them are people who have young children, particularly female workers, during this period. So it's been an open question over the last couple of years, how quickly and if we're going to see a return to the pre-pandemic level of labor force participation. And what we're seeing right now is that it's just kind of hovering at a lower level. We know that we also seen a lot of people take early retirement. Retirement tends to be kind of sticky. People sometimes unretire, but it doesn't. It's not something that people do quickly. So this is kind of a sort of a indication that we're kind of seeing a longer term structural change maybe in the labor market. Again, one of the challenges with this concept of full employment is there's not really a magic number that we can say, oh, this is what full employment looks like. We just have to look at a bunch of different metrics. Another related one, this is labor force participation. So the percentage of people in the household survey who tell us that they are currently out of work, or rather that they're either currently working or they're out of work but looking for work. They're either employed or unemployed, but not people who have pulled out of the labor market and just said, I'm not in the labor market anymore. I'm
No, there's a
retired.
couple of questions.
Yeah. Thanks for interrupting. Yep.
No problem. Is the phone survey the only way that they count people dropping out of the labor market?
So that's go ahead.
And then there's a couple other questions. So do you want to answer that one first?
So that's a really good question. This is something that's been raised. They do the household survey by phone. They call people up to ask about their employment status. Obviously, there are issues with doing that now because of the number of people who they do, by the way, call cell phones. So it used to be the case that they were only landline surveys. But the same kind of issues that you run into with those that you would run into with political polls, right? And so we've just gone through a season where people have been haggling about whether or not electoral polls are accurate. And we have, some of the same statistical issues. The Bureau of Labor Statistics does. You could go onto their webpage. They've written quite a bit about these kind of various challenges and adjustments they've made to their methods. But it is a challenge, especially now that most people are using cell phones. And if you get a call from an unknown number, you might be prone not to answer that number. So that's one of the challenges that we have. There are ways of checking it and calibrating it against other data that we have. So they make adjustments to their estimation procedure to take into account these longer term structural changes and how willing people are and able people are to answer the polls. So they're doing the best they can, but it's just one of the measures that we have. This is part of the reason, though, why I think the payroll survey, the survey of businesses that we get the employment numbers from, is a more robust number. That's why I think it's useful to look at the employment to population ratio as a stance of the labor market. And they can check these two things against each other. They issue both of the different estimates every month. And if you want to get kind of more geeky about statistics than that, we could. But that's that's the short answer to that question. Is basically they're doing the best they can, and there are challenges with how people are willing to respond to surveys. And you all know, as business owners, you probably get a lot of surveys as well. I bug a lot of business owners by sending them surveys, and I'm aware that people have survey fatigue. So those are challenges we're always dealing with. Was there another question maybe in the chat?
There are.
Okay.
There's a couple there. Well, first of all, I would assume that if they're on a no call list, that they're not in the ones that are surveyed. And then there's a question there about making sure, are they equally tracking those that have exited the workforce compared to those that are seeking to work?
Yes. So the first one, they whatever laws apply to do not call lists, they're going to have to observe, obviously. But the second question is, are they equally tracking those have exited the labor force? So that household survey, to the extent that it's that those numbers are reliable. This is another thing that going back to the last question mentioned. They do it is useful to follow these numbers over time because the kind of error that's introduced into surveys statistically, you can kind of smooth that out over time, which is why you never want to make too much, by the way, of a 1 month change in the data, because there's a lot of noise in the short-term changes in the data. But longer term, we're more confident in the numbers. So with regard to the people who've exited the labor force, yes, they're, the household survey basically asks people whether they're working, whether they're unemployed but looking for work, whether they've left the labor force. There's also broader measures of unemployment. They ask people whether they're working part-time but would like to work full-time, whether they're working 2 jobs but would like to only have 1 job. And those are actually, a lot of those different metrics have been really interesting to follow over the last couple of years. So one, just to kind of anecdotally, I don't have a chart for this, but one interesting one is employment. We've seen a strong recovery in employment, as I was just showing you earlier. One thing that's changed since the pandemic is we have a much smaller number of multiple job holders now. So pre-pandemic, it was the case that you had a lot of people who were working multiple part-time jobs. Maybe you had a job working nights at a restaurant, and then you also worked weekends doing construction or something like that. And you're seeing fewer and fewer people, a larger share of the workforce is employed full-time, and that's consistent with the kind of shift in the dynamic in the labor force right now. So that's a really interesting one to look at. But yeah, they do try and account for, or not, they don't just try and account for, they do measure the share of people. And again, that's reflected in this chart. That's kind of the residual here, the percentage of people who are what we call the civilian non-institutional population. So 16 plus, not incarcerated or in other ways, not able to be in the labor force. And you can just say, this is all the people that are either working or looking for work. And the balance is people who are not in the labor force. There's a lot of reasons why, and that's a little bit more of a black area, right? We don't know necessarily, but we do know some things. We know, like retirees, for example. But there's a lot that we don't know about people who are out of the labor force just because they're out of the labor force. So we don't get to have as much contact with them. So this is a really, we'll say, really active area of discussion and research. One thing that's important, one of the great things about economics, though, I'm sure a lot of you have studied it or at least taken introductory economics, is that, we know that there's a supply and a demand side of every market. And here we're talking about the, mostly the supply side, that is the supply of workers. Kind of hard to measure labor demand directly, but we know from basic economics that we can look at the price of something and kind of gauge where these are relative to each other. And one thing that you can say, looking at wages, which is the price of labor, is you can see in the data that we have on wages that the labor market is a lot tighter. So you can kind of just see what I've got here is the year-over-year change in percentage terms in wages for a few different categories. I'll show you another slide on this in a minute. And you can see that this is kind of an interesting story of the last 10 years or so. You have that kind of phase of the recovery from the Great Recession, where it was kind of a slow recovery. And we were seeing kind of, there was a lot of discussion about, why the labor market wasn't recovering more robustly. We were hearing a lot of anecdotes from businesses that we talked to about tight labor supply, but we weren't seeing it show up in the wage data. Wage growth was still lower than it was. I don't have the pre-Great Recession data on this chart. And then you see around starting at about 2016, but really in the years prior to the pandemic, an acceleration in wages. You see higher wage growth in that period. And that was kind of more consistent with what you would expect to see in something close to a full employment economy. And then the pandemic came and scrambled the whole picture, created measurement issues with wages because people who earn less were more likely to have lost their jobs. Obviously, if you're more likely to lose your job working in a hotel or a restaurant, there was this weird thing that happened where we saw average wages jump at the beginning of the pandemic, but that was just because the people who were still working were more likely to be higher earners. So once you smooth that out, it's interesting to look at the kind of sectoral basis. A lot of you would fall into the manufacturing sector, and you can see that that the level of wage growth since the kind of recovery from the pandemic, since we'll say late 2020, early 2021, as things started to open back up, has been a lot higher than it was even at the relatively strong compared to the relatively strong labor market prior to the Great Recession. So this is a sign to us that even though in aggregate terms the labor market hasn't quite gotten back to where it was pre-pandemic, we're still seeing a pretty tight labor market, and that's consistent with workers having either more bargaining power or more ability to exit the jobs that they're in and take higher paying jobs. And we also have a lot of data on that, on quits and job openings, and those are all really high right now and have been remaining pretty high, even as some other economic indicators have slowed down. And that's consistent with higher wage growth. Now, one important thing I want to point out, though, is this higher level of wage growth, this nice story for workers, is not true once you adjust for inflation. I'll show you what the inflation adjusted numbers look like in a minute. Here's just a kind of quick overview of a bunch of other industries. These are very broad categories, but I'll call your attention. We've seen really strong growth in leisure and hospitality. That was obviously the hardest hit sector by the pandemic, one of the lowest paying sectors as well. And this is that phenomenon. You can see in this chart that phenomenon of businesses having a hard time staying open because they can't find workers. A lot of people who used to work in this industry have taken jobs elsewhere, maybe working in printing plants, maybe working in other factories or working in construction. But we know that that's we've seen the biggest growth in wages in that industry, and also in transportation and warehousing. And there's your supply chain crisis in a nutshell. A big part of the supply chain problem is that it's gotten a lot more expensive to hire truckers and other people working in transportation. And so we've seen more acute wage pressures in that sector, but you'll see them going down in a minute. Or rather recently, and again, I'll show you the inflation adjusted numbers in just a minute. But that's kind of a quick sort of overview of where we are with respect to the labor market. So just to kind of sum up, pandemic was a really unprecedented shock to the labor market, but it was a temporary thing because a lot of people were sort of furloughed, had a lot of measurement issues. A lot of people early on in the pandemic didn't know whether they had a job or not. But what we can say is that things recovered fairly quickly, but it was such a large shock and it happened in such a small period of time that it was, following it in real time was a serious challenge. And so we at the Fed my colleagues and I really kind of invested a lot more heavily in our surveying capacity because we needed to get more up-to-date information than what we were getting from the official government statistics that are available. But what we can say now is that we know that the concerns that we hear from businesses about how hard it is to hire and how tight the labor market are being borne out in the data, and we're certainly closer to full employment, however it is you quantify that, than we were a year ago when inflation, or a year and a half ago when inflation really started to take off. So let me get into the inflation picture in just a minute, but I just want to ask real quick. I think this is maybe kind of a knuckleheaded question, but just want to ask kind of what the impact of what impacts you're seeing on of the acceleration in input costs on your company. Just you can see the categories there. Looks like some of you are actually saying no impact. If you're seeing significantly negative impact, that would be D. Slightly negative impact B, moderately negative C. You can see I've kind of skewed the categories. They're not symmetrical here. I don't expect too many of you are seeing a positive impact. Although if you are, we'd be happy to hear from you because those are interesting. Those are interesting nuances to the story as well. But I know pretty much every business I talk to, and we see this in our surveys as well, is telling me their input costs are still, even if they've slowed down, the rate of growth has slowed down, they're still really elevated right now. And it looks like the majority of you are seeing pretty, either moderately or significantly negative impact on costs for your companies. Not really surprising, but I think it's worth asking about just to kind of see where people are. And again, you can, just to point out that we're not asking about this in a kind of a symmetrical way because we know that, that this is a big challenge for businesses. So just to kind of, I just one other kind of, maybe slightly more, I'm not going to say optimistic, but just to kind of get a sense of where things are going over the last couple months. Just want to get a sense for what you're seeing in terms of the impact for your company, or rather the trend in prices for your company. Are you seeing just a kind of a leveling off would be C? If you're seeing the pricing environment get better a lot, that would be A. Somewhat better would be B. Somewhat worse would be D. And if it's getting a lot worse, that would be an E. So this is something, again, we're kind of acutely attuned to, because when I get into talking about what the Fed is doing about inflation, one of the challenges that we face is the actions that we're taking now are going to have their effect in a lot of cases in the future, and in some cases pretty far into the future. So it's sort of like steering steering an ocean liner, and that the adjustments you make now are going to have some of their effects down the road, and you kind of need to get out ahead of where things are headed, which is kind of underlines why it's so important to get this kind of information from businesses like yours, because you have access to information that's not showing up in the official data yet. So it looks like a couple. Oh yeah, we got a couple questions. It looks like some people are still chiming in. So yeah, why don't we get to the
So we have one attendee that says they actually have a positive impact to profits while supplies went up. So did their markup, so they could hide their costs.
That's interesting. That's really interesting. There's a lot I could say about about I guess sort of the impacts of inflation, and maybe I should have a category for a positive impact on that previous question.
Yeah, if they're able to charge more, even though the cost of goods sold are more expensive, in this case, they're able to charge more because of that, and in other situations they wouldn't be.
Yeah, and I'll point out, I mean, this is a sort of might seem unrelated, but one of the sectors I follow very closely is agriculture. And what you've seen happen in agriculture recently is input costs have gone way up. Fertilizer has gotten insanely expensive. You're talking mid double-digit increases year over year in the price of fertilizer and other inputs in agriculture as well. But crop prices have also gotten so much stronger that for a lot of producers, it's translated into higher income. Now, in some cases, they're using inputs that they bought before prices spiked, and what they're concerned about is having to buy them to produce next year. You're growing an acre of soybeans or corn next year with inputs that you have to buy now, and are the crop price is going to hold up, and is that still going to balance out? So it's a challenging picture for ag producers as well right now. But that's just kind of another example of the way that sort of nets out for people. And I think one of the interesting things, I'll leave that for now. Actually, I want to get into a little bit more information, but maybe we can circle back to that at the end. And by the way, I do want to encourage anyone in the audience, to please feel free to chime in and share your experience like you've been doing, because I know that the part of the purpose of your meeting is to interact with each other as well. I don't want to monopolize your time. But now I'm going to just kind of get into what do the official data have to say about inflation, and kind of tell you a little bit of story about some of the factors that are driving inflation that are maybe structural factors, or at least we'll say supply side factors that are harder for the Fed to influence with the tools that we have at our disposal. But let me just kind of start with a quick rundown of kind of how do we measure inflation. Ultimately, actually, let me start with just to kind of level set. What do we mean by inflation? And when economists, when monetary theorists talk about inflation, what they're ultimately talking about is the value of our money. We tend to think of the value of things as being enumerated in dollars or money. But money is just a good that is just universally tradable for other goods, and its value is determined by supply and demand as well. The challenge is we don't know. There's not necessarily a price for a dollar. What a dollar is worth is what you can buy with it. And so, in order to measure inflation over time, we have to look at prices, and this kind of gives you an idea of of what's happened to the value of a dollar by looking at what you can buy with it over time. And so the consumer price index is one statistic that's been collected for more than 100 years by the Bureau of Labor Statistics. It was originally created as an attempt to measure kind of the cost of living, give employers and unions or employees some sense of what their wages were worth, and kind of some more information to inform the bargaining process. And so that's kind of the original intent of the consumer price index. The way they calculate this, they're trying to summarize the cost of living in one number. The way they calculate it is they have a team of almost 500 economists around the country who literally go to grocery stores, hair salons, daycare centers, and a lot of other businesses and record the prices of goods, and importantly of services as well, because people spend a lot of their money on services. And essentially they just take all of this data and they average it up, but it's a weighted average, and the weights are determined by how much of a typical household's budget is devoted to a given category. So just for example, people spend on average, there's no such thing as a typical household, but we know from the surveys that they also do to help inform this statistic, a typical household spends somewhere from 10 to 13% of its budget on groceries. And so the weight that all the different food categories, I shouldn't say groceries, food, that includes food away from home, restaurant meals as well. So food gets a weight of about 11% roughly in the consumer price index. So all these different statistics they average them together, they weight them by how important they are, and they summarize this over time by calculating the consumer price index. And what I'm showing you here is the year-over-year change in the CPI. And I've given you two different measures here, headline and core. Headline includes food and energy prices. That's what we care about at the Federal Reserve in terms of inflation targeting. But the challenge is that food and energy prices are more volatile. They're more likely to go down than a lot of other prices, which are stickier. And so sometimes you get a clear signal of the tendency of inflation by stripping out food and energy prices, which are just kind of more noisy. And that's that core number you can see. This is sort of an academic question at the moment, because any way you look at it, the rate of inflation is a lot higher than we want it to be. And the Fed, by the way, I should mention, about 10 years ago, a little more than 10 years ago, declared an official medium to long run inflation target of 2%. That's kind of where we want inflation to come in. Why 2%? It gives us a little cushion above zero. When inflation actually goes negative, when you have deflation, that can lead to serious financial problems. It's actually part of the story of what happened during the Great Depression. Maybe a digression I don't need to get into right now, but again, happy to talk about that if people have questions. More importantly, it's not necessarily important that the value of a dollar be perfectly stable over time, but just that inflation, the value that the prices be somewhat consistent and predictable over time. So we really want inflation to be stable over time. And what we've seen over the last year and a half is it's gotten way above an acceptable level. And so that's what's been responsible for the Fed's pivot. Now you might point out, well, we started to see inflation jump above 2% in early 2021. Why didn't we do something more about it then? That's what I'm going to get into in just a minute. But that's just kind of a quick overview of where we are now. You might have seen the news last week. We got a new reading on the CPI last week. It came down a bit on a year-over-year terms in October, and the monthly growth in it was a little bit lower as well. So it wasn't just that we've got a higher baseline that we're calculating from. But we've seen some deceleration, but it's still way above where we want it to be, which is part of the reason why the Fed's been acting so aggressively to try and bring inflation down. Apologies, I have this labeled September. This should be labeled October. But this is just to kind of give you an idea of, that the CPI is an interesting number because it tries to summarize the value of a dollar or the cost of living in one number. But it's interesting to kind of look at where the big changes are. You can see that, I just kind of broken out a couple of sort of pertinent categories from the CPI. And again, these data are all available from the Bureau of Labor Statistics. It's all public information. The biggest increase that I have, at least on this chart, is in airline fares. Probably no surprise for anyone who's flown recently or anyone who's planning any holiday travel. And again, I'm just going to make an editorial comment real quick here that this is just a measure of the price of traveling on an airline. There's no adjustment for quality of service. You can see that the energy categories are up a lot in year-over-year terms. If I were to show you this chart A few months ago, though, it would have looked pretty different. You would have seen gasoline up by more than 50% year over year, still up a lot year over year. Part of this is just as time has moved on, we're calculating relative to a higher price of gasoline. We're getting into now. We started to see energy prices climbing late in 2021. They, of course, really spiked after the Russian invasion of Ukraine. And that was reflected in a really big surge in both the price of gasoline, but also in the overall rate of inflation. And I'll show you the breakdown in a minute. But a lot of the increase in inflation that we've been seeing this year has been due to cost of energy, and a lot of the downward momentum that we've been seeing in the last few months has also been due to downward movement in energy. A lot more to say about that, but you can just kind of see big time food inflation. This is another big story. Again, one of the really sort of pernicious things about the current surge in inflation that we're seeing is it's hitting categories that are more sensitive for lower income earners. So, I mentioned for the typical household, maybe food is only 11% of your family budget. But if you're living at the poverty line, you're dedicating a lot more of your budget to food. So this inflation really bites the budgets of low income people a lot more than the inflation that we typically see. One thing at the bottom of the chart here that I'll draw your attention to is used cars and trucks, only up 2%. This is a very different picture than if I were to show you this a few months ago. It was the leading increaser and a big contributor to inflation. The car market has been really kind of driven haywire by the supply chain crisis. You're all familiar with the semiconductor. I'm sure you're familiar with the microchip and semiconductor issues that have been plaguing global supply chains. That's been having a heavy impact on the supply of new cars. People responded to high prices and long delivery times for new cars by buying a lot more used cars. Because used cars have a high weight in the index, you don't tend to buy cars a lot, but they're a large part of your budget. And so they have a big weight in the index. So that was driving a lot of the activity we were seeing in inflation. I'll show you kind of more about what the contributions have been from these things in a minute, but I'm going to go back to that wage picture just to point out a couple things here. So I was showing you earlier this happy story for workers, at least, that we've got a really tight labor market and it's driving up wages, putting more money in their pockets, but not when you adjust for the value of a dollar. When you adjust average hourly earnings for inflation, you can see that for most of these categories, recently workers have taken a pay cut in real terms. And that's true for some of these other categories as well. I'm not going to dwell on this, but I just want to make the point, two quick points about this. One, it underlies one of the really pernicious consequences of inflation, that it hurts people's earning power. It sort of robs them of the real value of their earnings. And that's why keeping inflation low and predictable is such an important part of monetary policy. But it also kind of highlights what we're seeing about this current surge of inflation that's different from a lot of historical episodes of inflation, where we often think of inflation as being sort of driven by wages, where you see really there's this old idea in economics that there's a trade-off between unemployment and inflation. Unemployment gets too low, that drives wages up, that feeds through the cost of everything else. Even though that story kind of feels true right now, because we know that we have high inflation, we have a very tight labor market and low unemployment rate. What we're seeing right now is that wages are actually chasing inflation. So they're not driving inflation; they're lagging inflation right now, and so that kind of highlights, a couple things. One is this simple story that you might learn in intro macroeconomics about the Phillips curve, that there's a trade-off between unemployment and inflation is actually not the whole story, and in fact can be kind of misleading, and kind of creates this perception that the Fed or other policymakers can kind of trade higher unemployment for lower inflation or vice versa. We don't think in those terms. We don't think in terms of, we've got to bring inflation down. That means we've got to push unemployment up. I'll talk more about how we do think about it in a minute, but that's just to kind of underlie what we're seeing in this current bout of inflation is a little bit different from that textbook story of wage push inflation. What is going on? Well, part of what's going on is a big surge in demand. So just to kind of give you, this is the next couple of charts are going to tell a lot of the story behind what was going on with at least the initial surge in inflation that we've seen. And like a lot of other charts that I've shown you, you see that big drop in in early 2020 with the pandemic. So what I'm showing you here is spending. So this is not a price index here. This is personal consumption expenditures. So this is just monthly spending by consumers on a few different categories, and they're indexed to their level in February 2021. So I've got durable goods, non-durable goods, and services. The indexed part is important because in magnitude terms and aggregates, people actually spend a lot more of their money on services than on goods. What we saw in the beginning part of the pandemic is, aside from an initial surge in non-durable goods purchases, that was that panic buying wave that we saw in the early stage of the pandemic, where we were in shortages of toilet paper and paper towels and things like that. All these things dropped early on in the pandemic, but durable goods purchases in particular, so goods spending in general and spending on big ticket household items. So durable goods are things like automobiles, appliances, electronics, things that last longer than a year. Those not only recovered right away, but really surged. The kind of growth that we've seen, you can see kind of year over year growth of like 30% in durable goods purchases, or at least relative to February 2020. This huge surge in spending on big ticket household items. What was going on here? Well, a couple things. Well, I don't want to elide the fact that people got mailed checks, and that probably didn't hurt. We all remember that. But also, as I mentioned a moment ago, people spend a lot of their money on services, on things like going to hair salons, traveling, having meals at restaurants, and a lot of the ways in which people normally spend their money weren't really options early on in the pandemic, back in mid to late 2020, and so people just started substituting. They weren't able to spend their money in the ways they're used to by, say, traveling or going out and eating at restaurants, and so instead they started buying more stuff. They started buying, in particular, they started upgrading their houses. We saw a huge huge surge in construction materials prices. That was kind of the first wave of this, and that's held up pretty strongly. So we've just had this big surge in demand for goods, and now we've actually seen spending on services is a little slower to recover, but it's back to its growth path. But I just want to point out a couple things here. One is that this kind of growth is really unprecedented. If I were to show you this chart going back for a long period of time, you would just see what it looks like from January 19 to January 2020, just this long, slow and stable growth. Consumer spending doesn't bounce around a lot. It's a lot more smooth than a lot of other economic data series. And so to see this kind of growth in spending on goods is really unusual. I can't underscore that enough. And it was reflected in a big increase in the price of goods relative to services. So this is just the ratio of the price index for durable goods to a price index for services, just to kind of give you an idea of what goods are costing relative to services. I'll show you in a moment. Most of the inflation that we see in normal times actually comes in services. It doesn't come in goods prices. In fact, goods prices actually are negative contributors to inflation over time. Goods get cheaper relative to services over time. And again, this is one where if I showed you this going back 50 years, you would see a long, steady decline in the price of goods relative to services. Why is that? It's a technology story. You can produce more goods with fewer people. Because of improvements in productivity. Services still require people. People don't get cheaper over time. So over time, we tend to see services get more expensive relative to goods, or the vice versa, goods get cheaper relative to services. And what we've seen is a big reversal in that. And it's changed. You can see it kind of coming down in the last few months. But what happened starting in kind of the mid 2020 and really especially in last year, we saw a big surge in the price of goods relative to services, and this led to overall sort of inflation in the price of goods, and it's also behind a lot of what's going on in the supply chain. Obviously, there's international things going on in the supply chain. There's the COVID, lockdowns in China and all sorts of stuff like that. It's a complicated story. There are issues at our ports. There's the labor supply for truckers. There's a lot of stories you can tell about what's been going on in the supply chain, and they're all important. But fundamentally, a lot of it has just been essentially a traffic jam. People want to buy a lot of stuff. The supply chain only has capacity to deliver so much of it. So just like roadways only have capacity to deliver so many cars to their homes at 4 p.m. on a weekday, You tend to see traffic jams. That's what's been going on in the supply chain, and it's led to big increases in the price of goods. And you can see that when you break down the year-over-year changes in inflation that we've been seeing into a few different categories, and that's what I'm showing you here. So this chart might look a little wonky to read, but what I'm showing you here is just on a year-over-year basis in any given month, the percentage of the inflation that we're seeing that's coming from goods, that's in gold, services is in that kind of navy blue, and then energy and food. So energy is in that light blue and food is that kind of teal blue-green color. And so you can just see kind of what's the share of inflation coming from these things. And what I want you to take away from this is in the early wave of this surge in inflation that we're seeing, a lot of the activity was driven by goods. And then a lot of it was being driven by food as well. And this is pretty unusual. And then, of course, over the last year, we've seen big surges in energy prices. So all those things have been contributing a lot to inflation. So going into late 2021, it looked like a really important part of, a lot of the inflation that we're seeing was due to the supply chain issues. And as I'm going to show you here, things that were kind of pandemic related. So what do I mean by pandemic related? So I mentioned earlier that people spend a lot of their money on services. So lumping a few of those things together, like airfares and lodging costs and a few things that were kind of heavily affected by the pandemic. And now by the way, I'm showing you the monthly change. I was showing you yearly before, just to kind of give you an idea what was happening month by month. And you can see, looking at this chart, that early on in, early in the pandemic related services, things like airfare were actually negatively contributing to inflation. And then I've got vehicle related broken out specifically here because that's just there was a lot of, you can see in the middle of last year when we started to see inflation really take off, a lot of the action there was being driven by vehicles, was the supply chain issue. As I mentioned earlier, vehicles have a big weight in the cost of living. And we were seeing big increases in used car prices and also in car parts and other things like that. So kind of lumping those together through the middle of last year, you could tell a pretty convincing story that the acceleration in inflation we were seeing was mostly due to a rebound effect from the pandemic and the supply chain crisis. And what happened over the following months into late 2021 and into this year is, for one thing, the supply chain crisis didn't go away. A lot of people were thinking that it was, sort of a temporary phenomenon that was also pandemic driven, but we've still seen consistent, vehicle price pressures. And also, more importantly, that inflation got more widespread. So you start to see prices of services take off. You start to see prices of other broad categories of goods take off that hadn't been taking off. So it wasn't just, early on the surge of inflation, you could tell it was pretty convincing based on the data that we had available to us at the time. And people were using the term transitory, which nobody likes to use anymore, but that this was maybe a short-term surge that was heavily driven by supply chain and pandemic. And what's happened is it's become more widespread since then. And so that's kind of a long way of getting into why the sudden pivot in policy by the Fed. And pivot we did indeed. Oh, apologies. I have the wrong chart here. So what I should be showing you here is the Fed funds rate. But it's not news to you to point out that the Federal Reserve has ratcheted up its benchmark interest rate. So after dropping it down to zero at the beginning of the pandemic and holding it there for a long time, we raised the benchmark interest rate by 25 basis points at 0.25% in March. And there was an immediate response, and apologies that I don't have the data to show you. There was an immediate response on in other market interest rates, in the mortgage interest rate, in the 10-year Treasury interest rate. All those rose in response. And since then, the Fed has the FOMC has increased that benchmark interest rate by 0.75%, 75 basis points, 4 times in a row, which is really unprecedented. The first time we did that, we hadn't done it in more than a decade. And we've done it now several times in a row. And that was just because it became clear that the inflation we were seeing was not only not only high, but it was accelerating. It was becoming more widespread, and we needed to do something serious to bring it under control. Now, the problem that we have is our tools that we use to fight inflation are demand-based. So a lot of the inflation, as I've been kind of pointing out, has been driven, sort of through the supply side of the economy because of global supply chain issues. By the way, I'm not going to show you any international data, but inflation in the Eurozone is even higher. Inflation in the Far East is high as well. So the inflation that we're seeing right now is a global phenomenon. It's not just a United States phenomenon. So that's all just to say that, a lot of the inflation that we're seeing has been supply driven. The Fed can fight inflation primarily through the demand side of the economy by bringing down on demand. By we raise interest rates, we make it more expensive to buy a house, buy a car, to expand a plant, build, break ground on a new building, and all of that is going to bring down demand. And we're seeing signs that that's happening in the economy, and it is having some effect on decelerating inflation. One of the challenges that we have, though, is that a lot of the inflation, as I said, we're seeing is due to supply effects. And apologies that I don't have the interest rate chart to show you, but that's not news. The Fed's been raising interest rates, and we've seen mortgage rates go up. We've seen Treasury rates go up. One of the other tools, just to mention real quickly, that we have at our disposal is the size of our balance sheet. So you heard this term quantitative easing, where we, printed money, essentially digitally printed money in order to buy assets in response to the financial crisis. We really increased the size of our balance sheet in the pandemic and continue to do so for some time following the pandemic. And what we started doing more recently is allowing some of those securities to mature. A lot more I could say about that. And I'm happy to talk about how that works, but you can kind of see that, that's starting to taper off now. We're starting to reduce the size of our balance sheet to pull money out of the economy in order to fight inflation. But our primary tool that we use is that interest rate benchmark that we influence. And that's just as, just to kind of sort of wrap things up there, that it might seem like we sort of changed our stance fairly abruptly. Part of the reason for that, like was that the employment story wasn't as clear at the time that we saw inflation take off. As I was showing you, mid 2021, we were still 8 million fewer people working nationwide, so well below full employment. But once we started to get closer to that pre-pandemic employment level and inflation really started to take off, then we knew we had to do something. We had to do something pretty dramatic. Now, one of the good things, and I'll end on a somewhat positive note here, aside from the fact that we've seen some deceleration in inflation in recent in the last couple of months, it's not enough. We need to see it come down a lot more. But longer term inflation expectations based on some of the market indicators that we have are relatively stable right now. So you can kind of see this sort of what we call the 5-year break-even rate. That's kind of in a measure of looking at the difference between different treasuries. What the market's best guess of the inflation is going to be over that 5-year window or the 10-year window you can see on here. And those are both down much closer to that 2% level. They've gone up obviously as inflation has gone up, but they've stabilized this year as the Fed has tightened policy in response to the surge in inflation. And the 2-year inflation rate as well. And so again, more I could say about that, but I've been talking for quite a long time. And I want to thank you all for participating in my surveys that we had. And with that, I'm going to yield the balance of my time, and maybe folks have questions, or maybe you just want to talk, to actually talk about your actual business and change the subject, and that's fine with me. So thank you for listening to me today, and just sharing my contact information. If any of you want to get in touch with me after we're done here today, happy to stay engaged. Thanks.
Joe, this is Rick. Thanks for that presentation. It was great. I had a question, in terms of the outlook for you said inflation is still up there and it's got to come down. I know you can't predict the future, but what is the Fed's stance going forward with continued interest rate hikes? Is that
so I'm not gonna make a prediction about future interest rate movements. But what I can tell you is so we try and be really transparent about about the outlook going forward, because we know that things work best when we're not making any big surprises. So there are two kind of official statements to look at. The first thing I'll just say is, if you read the financial commentary, you're going to get a pretty good sense of where things are headed. Don't spend too much time listening to Fed tea leaf readers, because that's just a cottage industry of people who like to hear themselves talk. Not that there's anything wrong with that. But no, the official sort of word on forward guidance on future policy is that every time the FOMC meets and makes that decision, so they just met actually a couple weeks ago and raised the benchmark interest rate another 75 basis points. And after they meet, they put out a statement saying, here's what we did and why. And they try and telecast in that statement. I mean, there's a few things that they want to make clear. One, these decisions are data dependent. So we don't go into it thinking we need to raise interest rates another 1.5% within the next 6 months or something like that. It's not a kind of a mechanical thing that we're committed to. It's more based on what we can say right now about what's happening with the tendency of inflation and what's happening in labor markets. We know we're still, we're not missing that full employment target. We're not seeing huge increase in unemployment. In fact, labor market's still very strong right now. Inflation's come down, hasn't come down nearly enough. So that means that that policy at least needs to stay tight, if not get tighter. One of the things they changed in the most recent statement was they made an acknowledgement of the long and variable lags that policy acts through. So making just acknowledging that, yes, we do pay attention to the fact that what we're doing right now is going to have its effects in the future, and there's a risk of overdoing it, of overcorrecting, right? Now the good news is, if they do tighten too much, they can change that decision pretty quickly. It's pretty easy to lower rates back for them. Just like it's easy to raise rates. When I say easy, I don't mean to say it's easy. They need to buy and sell billions of dollars worth of securities in order to make that happen. But they can adjust the stance of policy as the data come in. So they try and make it clear that the policy is going to be data dependent. And what we can say about the data right now is, though inflation has slowed down, it's still way too high, and we need to see it come down more. But we also know that there are risks of overdoing it. The other sort of forward guidance that they offer is on an every other, so they meet 8 times a year. On an every other meeting basis, they put out what they call a summary of economic projections, which is kind of says, here of the 12 Reserve Bank presidents and the X number of governors, 7 governors that sit on the FOMC, here's what all of them think here's all their predictions for these various metrics. So they predict the target rate of inflation. That's the PCE rate. I can talk more about what that is in a minute. And then employment, GDP growth, and in particular, the federal funds rate going forward. And if you look at that, you can kind of see not just the average of their sentiment, but also their individual votes. There's a dot plot of where they see things going. And so the central tendency of that calls it, as of September, when they released it, called for that benchmark interest rate to go up to just around 5% through 2023, and then to come back down. Now that's not necessarily a commitment. They're not saying, here's what we're going to do. They're saying, here's what we think is probably what's going to be necessary to do based on what we know right now. And so that's kind of sort of the official guidance. I mentioned that they do that every other time. They didn't do it during this last meeting. So in December, they're going to issue another one of those. There's going to be a lot of attention paid to that. And you'll kind of see there's a lot of hand wringing over, are they going to raise it another 75? Is it only going to be half a point? Should they stop? I think actually the incremental changes in policy, the financial press really makes a little too much, a little much ado about. It's really a matter of, they're kind of communicating, here's where we see things right now, and kind of giving forward guidance. And the guidance they're giving is, we're tightening right now. That does not mean that we're entering a period of permanently higher interest rates, right? But what we're seeing right now is interest rates that are back to the level that they were in like 2019, right? Not not in all cases. Mortgage rates are higher than they've been in like 30 years, or not 30 years, but since before the Great Recession. But the benchmark interest rate, the Fed funds rate, is right now just kind of back at its level because there's been a long-term decline in all interest rates. Again, a lot more to say about that, but that's kind of the forward guidance right now. They're expecting they're expecting that they're going to have to continue tightening, but because of the risk of overdoing it, they're probably not going to be slamming on the brakes as hard as they've been.
Thanks.
Yeah.
So I have a quick question. When is the next committee meeting scheduled, and how does coming in the holiday season and the consumer spending during the holiday season, how does that impact maybe when they meet or how they might adjust rates?
It doesn't impact when they meet. They set up the calendar a year in advance, and they tend to happen around the same time every year. So the next meeting, I'm gonna get it. I'm not gonna nail the date exactly, but it should probably be the first full week of December. So I'm thinking it's gonna be. Oh no, I'm sorry. Actually, it's going to be the second week of December. So it should be like around December, December 13th, 14th. So yeah, right before right in the midst of the holidays, really, right, certainly right in the midst of the holiday buying season. We did, by the way, just get consumer spending numbers out for October. They came in very strong. That's kind of one of the things that's been sort of puzzling about the period that we're seeing right now. Again, typically you expect, tightening monetary policy, increases in interest rates to bring down demand. They've been bringing down demand in the areas that you certainly expect to see it first, like housing. Residential investment has come way down. The housing market has cooled off significantly. The growth in housing prices has really flattened. And by the way, a lot of that information is not reflected in the inflation statistics yet. Housing, this is an important thing to point out. Housing is another really huge part of most people's budgets, and so the cost of shelter is an important part of the CPI. The way they calculate it is a little goofy. They kind of look at older data and they do it on a kind of a rolling basis. So we've started to see the real-time indicators for housing and shelter costs, rents, have been moving down a lot more rapidly than they've been moving down in the CPI. So once those get reflected in the CPI, we'll probably see further downward movement in inflation. That's something that a lot of people have been commenting on recently. So as far as the next meeting, going to happen in a couple weeks. Or not a couple weeks, it's going to happen in about a month. In terms of their mindfulness about what time of year they do it, I don't think they necessarily think. I mean, everyone knows that consumer spending goes up during the holiday season. It goes up during the back to school season, and so we try and kind of adjust for those usual typical seasonal surges. With the back to school season this year, even taking into account the typical seasonal surge, was really strong. And preliminary indications that we're going to see pretty strong holiday spending this year. So kind of one of the interesting things about there's a lot of commentary on, are we heading into a recession? Because that's the consequence of kind of strong monetary tightening, is that you expect to see a big slowdown in economic activity, and that's going to potentially cause a recession. Is the Fed going to have to engineer a recession to bring down inflation? That's, again, not necessarily the way we think about it. We don't think about about that kind of trade-off in those terms. There's actually a lot of room for we'll say deceleration before we really tip into serious recession territory, because the labor market is still really strong. The unemployment rate is really low. Employment numbers still continue to come in really strong. October employment came in over 200,000, which historically speaking is very strong growth, and it's been slowing down from even stronger growth earlier this year. So the labor market is still really strong. Consumer spending is sort of persistently, stubbornly strong, if you will. And part of that is because people have a lot of savings. People still have a lot of money that they stashed up when they weren't able to travel. Earnings are up. And so all that is kind of translating into pretty strong demand still. The things that you expect, like I said, like housing and construction, particularly residential, to the more interest rate sensitive parts of the economy are slowing down a lot more. But overall, we're still, in spite of the GDP slowdown in GDP, still pretty broad-based strength in the economy. And most of I'll just kind of point out, this is not my view. the kind of consensus economic forecast for next year. It's from Blue Chip, which is kind of a survey of professional forecasters at Fortune 500 and consulting companies. Their average of their kind of consensus of their expectations is for sort of a mild recession in 2023, and by mild I mean on the order of like a 0 to 0.5% contraction in GDP, which by historical terms is a pretty weak recession, and for that to be kind of weak and relatively short-lived. So long answer to that question, but I get a lot of questions about recession right now. It's the big thing that's on everyone's mind. We have a long way to go before we really get into a recession in general, but in particular, we're pretty far away from sort of severe recession territory still, which is not to say it's not a risk, but it's one of the things they have to keep in mind when they're making these decisions. They have to think about all the trade-offs and financial stability implications and things like that. Well, I really appreciate everybody sharing. I don't know if anyone in the audience has additional thoughts on current business conditions, what you're seeing, among your peers, what your expectations are for the coming year. I'd love to hear about any of that. And please feel free to reach out to me via my contact information that I shared and stay in touch. And again, I'd say, I love the opportunity to get in front of an audience like this where you have really high level people in at least what I consider kind of a bellwether industry, especially this time of year.
Great. Well, thanks again, Joe, for great presentation. A lot of good information. So, and you shared your information. You'll share the PowerPoint, or we'll share the PowerPoint.
I will once I can actually I'll be able to save all the responses that I got to the surveys. So once I save that, I'll send that to you via PDF, and you can share that with the folks in the audience or others if you want.
Great, thank you. Any closing comments, Teresa, or anybody else?
Great content. Thank you, Joe. We
Hope so.
appreciate it.
Yeah, I hope it was good use of everyone's time, and good luck to everybody, and have a happy holidays and Happy New Year.
Thank you. Have a good day.
See ya.
Great. Thanks, Joe. Bye-bye.